If you're a couple and you're just trying to get a house, but it just seems like you can't do it, this is the video for you. So before we go into what you can do and tips, how you can save your money, we have to go over the lender requirements. So that way you know what you can do to make sure you're satisfied on the lender requirements so you can get a house and get a pre-approval first. Number one is a good credit score. So ideally, if you have between 740 to 760, once you go above 760, your rates are getting significantly better. So if you want to find out more about how to get your credit score higher, there's a lot of YouTube videos that's out there that can help you how to bump up the credit score up to 700 and above. Number two, 2 years tax return. So your W-9 and also 2 years of tax return are very, very important. They're crucial. So make sure you have that prepared and ready to send it to your lender. Number three, bank statements. So the banks want to know where your money coming from and where you're parking these money in, whether in Chase account or Wells Fargo, whatever, where they are. But they also want to see how your spending activity, where's your money coming in and out. Now, with these, they might want sometime 2 months to 6 months. So make sure you have those and prepare to show it to them. Number four, so at the end, when you close the escrow, they want to see you have cash reserve just in case something happened, you somehow don't have work anymore, at least you have cash reserve up to 6 months. Now, these cash reserve could be retirement fund or also money that's already in your bank account. This concludes the lender's requirement of how to get a pre-approval letter. Now we're gonna go into the main topic. How do you save money for a home as a couple? So we're gonna go over the most important part, the down payment. It seems like it is the most intimidating part for most young couples. So we're gonna go over what down payment is and how do you save for that. So down payment is essentially what you put down towards a home when you purchase a property. Now, in Los Angeles, people typically put 20% down, sometimes 25%, but most of a young couple probably not be able to do that. There's also other programs like FHA, VA loan, or 5% conventional loans that you can get your most minimum at 3.5%. So before I go down further, you're gonna ask me, well, Robert, what if I don't put down 20%? I'm gonna get a PMI. Well, what PMI essentially is 0.5 to 1% of your loan amount, a mortgage insurance to protect lenders' assets, which is the amount that they are lending you. So if you want to save a 20% down payment and you want to wait for 10 years, that's okay, that's fine with me, I'm okay with that. But let me put a different perspective for you. Since the last 5 years, every year we have 10% increase. And now we're filming at March 2019, we're experiencing 1 to 3% increases. Now, your mortgage insurance are about 0.5 to 1% of your loan amount. Just put it in a different perspective, does this appreciation cover your mortgage insurance? Of course it does. So as a young couple, how do you get a lower percent down payment? There are programs such as VA loan with 0% financing. You have FHA, which is first time home buyer program with 3.5. They also have conventional loans at 5%. Those are the three loans that's typically what people will go for if they don't have that much of down payment. Okay guys, so we're gonna go over how to save your money every month a little bit later, but we're gonna go over a little bit of more unconventional way. How do you come up with the money for your down payment? So number one, you can use your 401k and you can use the money and pull it out and put toward your down payment. However, there's also another way, it's a Roth IRA, but that's another complex category. Well, you can look for that later, but I just don't want to throw it out there. Number two, you can join tenant with another person, such as family, spouse, or even your friends. When you're doing this, you share a 50-50% of interest, and you can always pay them back later if they put down the down payment for you. Number three, you can get a down payment as a gift from the friends or family members. Each person are allowed in $15,000 annually in 2018 to give to another individual tax-free. The lenders normally are okay with that as long as you have the trace to another bank account and they have that money reserve sitting there. Now, this does not mean that you don't need the money reserve when you close escrow. You can also use your 401k count toward your reserve of money just in case something does happen. So this is another leeway that you can kind of play around with it. So I'm not a tax accountant or financial advisor, but this is what I have learned throughout my real estate career. Now, there's also a little leeway that you can work the gift tax, is that you can also write a promissory note to the person who lends you the money as a gift. Now, With that being said, the lender will not need to know that you're borrowing money from this person. You just need to write an unsecured promissory note to this person and establish the terms and interest, how much you're going to pay them, and how fast you're going to pay them back on your own terms. But you need to keep this outside the escrow so the bank doesn't know. Okay, so after all these tips, and you still need a little bit of capital, I'm going to teach you guys how to save your money so that way you can get into your home 1 year earlier. But you're not in a relationship and you're single and you also want to use these tips, don't worry, these tips are for you. You can also use it. It's just that you're saving money quicker as a couple. Okay, so how do you save your money? Number one, there is no easy way to save your money. It's a matter of perspective. You have to live below your mean. You have to make it your priority. You can't go out to Metro and spending $200, $300 dining if you trying to buy a house with 13% down. That's almost like 1% or 2% of your down payment. So instead of eating out all the time, maybe you need to scale back, or if you go to the bar, you might want to sneak in a little flask if you wanted to, but that's all up to you. It's a mindset, like I said, you need to get it done and your priority is your house. So number two, banks are looking at your debt to income ratio. They do not want you to exceed your payment and your property taxes more than 44% of your income. Now, how do you get lower of that so you can qualify for more? It's basically, yes, you guessed it, up your income, ask for a raise, or reduce your expenses. So what I meant by expenses, if you have car or credit cards debt, get rid of them. Or if you have Disney Pass, if you don't go to it, get rid of it. If you have Orange Theory, downgrade it to 24-hour fitness. You're gonna make your life a lot easier when you're trying to buy a house. Number four, automate your saving. So when you have money directly deposit into your account, you want to automate that into your saving account. Like Chase, they have some type of program where you can save portion of that money directly into your saving account, so that way when you don't see it, you won't miss it. Number five, you can add side hustle or part-time job to increase your income, and that way all the small differences gonna get you a home much faster. So if you like my video and like the tips I'm giving to you, just press that thumbs up or follow me on Robert C. States on Instagram. And again, this is Robert C. States here. I'll see you next time. By the way, I'm not any financial advisor or tax accountant. I'm not giving financial advice. I'm just telling you this is what my experience is. So if you want to follow it, great. But if you don't come at me. Don't sue me, bro.